And we're back, new day and a brand new lecture, guys. So, in case you're looking at May 21 or November 21 CA intern, and if you're feeling that DT and IDT are seeming too big, then you've come to just the right place. So, if you attended my regular lectures and you want a quick revision of the entire tax, step by step, chapter by chapter, watch the videos, finish this one, move to the next one, and quickly revise every concept. What have I covered in these revision video lectures? I've covered everything: tips and tricks, shortcuts, or ways to remember the sections, ways to remember the bullet points. Everything is covered here. So let's begin, guys. All you need are my notes in front of you, maybe a calculator, and probably a place where you can write down stuff just to quickly revise everything. We'll start with the first chapter and we'll continue and go to the last chapter. Quick revision on everything that is tax for CA Inter May November 21. Welcome to SMAT. The first chapter that we begin with is the introduction to tax chapter. It's a very easy chapter, but it lays the foundation for whatever you learn ahead. So I'm just going to put that on the screen and let's quickly revise, guys, the first chapter. I'm just going to increase my, just one second. I'm just going to increase my video size so I'm visible to everyone, and let's do a quick revision of everything that is the first chapter. The first chapter, as always, is introduction to tax or introduction to income tax. All right, so how do we look at this, guys? You know, if you heard my regular lectures, you know that we do the entire DT, which is for 60 marks. We do it with the example of a surgeon and his family. So there is a surgeon who is in India and he is married. He has his wife who is also in India. The surgeon, as the name suggests, is into a business he has a clinic, he has a mini hospital. His wife is a jewelry designer. They have kids. They both have some children. Of course, the surgeon also has his father, so somewhere his father also plays a role here. The father spends about 100 days with him here, and the rest of the time he goes to the US and spends it with the surgeon's brother. The surgeon's bro or the surgeon's brother is also playing a big role. Guys, every chapter can be done with this example in mind. All right, the surgeon has a couple of questions in the first chapter. If you remember, the surgeon had a couple of questions for the government. Let's look at the question and let's quickly revise the first chapter. The first question that he asked, is that why does the government need tax? Why does the government need tax? And guys, you don't have to by heart this. You just have to figure 4 5 things why the government needs tax. It could be education, it could be infrastructure, it could be public health. Like right now in COVID, they need to spend a lot of money on public health. It could be bridges, railways, transportation. All these things are the reasons why the government needs tax. Next, guys, which the government, surgeon had the next question, which government collects the tax? Both the central government as well as the respective state governments collect the tax. Some taxes are also collected by local authorities like municipal taxes. Next, his question was that, okay, these governments are collecting tax, but what kind of tax do they collect? So they collect two taxes: direct taxes and indirect taxes, which is basically 60 marks and 40 marks of our tax portion. Next, he says, what's the difference between the two, guys? Just listing out the difference. Direct tax is progressive. Why progressive? Because the more you progress in life, the more you need to pay. Direct tax is paid by the person who earns it. So if you are earning, you need to pay direct taxes. And an example of direct tax is income tax. Versus that, indirect taxes is regressive. Why is it regressive? Because even for a poor person who does not have any income, he also has to pay indirect taxes. What is the next thing? That the person who pays the tax and the person who pays it to the government are different people. Example, when I go to buy an electric bike from electric bike company, I pay electric bike company 1 lakh 18,000. The 18,000 is GST. So I have paid it to electric bike company and they pay to the government. Same way, when you go to an electronic store to buy a phone, you pay the GST to the store owner and he pays it to the government. So basically it is an indirectly it is paid by you, but then paid it to some other person who pays it to the government. And next example, the best example is GST. All right. Guys, now our focus is the 60 marks of DT. So I'm just going to focus on DT right now. Of course, in case you want to revise IDT also, those video lectures will also be available for all my students at a regular batch. This revision really makes sense for people who already attended my lectures in the regular batch. The others also will try and make sense for them as well. Guys, next is DT. So how is the income tax levied under? The income tax is levied under a law called the Income Tax Act. This is the Income Tax Act, and that is in the year 1961. And you remember, they forgot, so they made the rules, and income tax rules were made in the year 1962. All right. Now, guys, these acts and these rules sound very old. So how do they make sure that they keep relevant? So in order to keep changing and making them relevant, the Indian government keeps introducing something called is the Finance Act. Actually, it's a bill which, when gets approval of the parliament, becomes an act. And this Finance Act is also popularly called the budget. Every year they come up with the budget and they make changes in the Income Tax Act 1961. They make changes to the Finance Act. What is relevant for your exam, guys, is Finance Act 2020. Any changes made in the finance till the Finance Act 2020 are applicable to you all. Next, this act, how is it structured? The Income Tax Act 1961, how is it structured? So let's tell you the structure. First, we have sections, then we have subsections, then we have clauses, then we have subclauses, then we have explanations, and in case they want to make an exception, they also have something called provisos. So that's how these are structured. So who at the government level levies these taxes, guys? Who at the government level will levy the tax? Guys, first of all, there is a Ministry of Finance. Nirmala Sitaraman heads it. So there is a Ministry of Finance. Under that ministry, there is a Department of Revenue. Revenue basically means the one who collects the tax. Under that, there is CBDT, Central Board of Direct Taxes. I'm only talking about the things that are relevant from DT perspective. All right. Next, guys, what are circulars and what are notifications? Circulars, C for circulars, are issued by CBDT and they're only and only applicable on the officers, that means the income tax department, and not on us. For us, there is something called notifications. The notifications are introduced by whom? The same people who have introduced notes. Notes and notifications, that is the government. They issue notifications and they're applicable to all of us. Notifications and next, guys, in the Income Tax Act, we come across a term called person very often. Who are these persons? Let's quickly revise who are these persons. The first person that you can think of is the individual, that is you and me, guys. Individual can be a major, it can be a minor, it can be a male, it can be a female, it can be a lunatic, it can be anyone that's an individual. An individual earns its own money and pays its own taxes. So it basically has a separate legal entity and a separate tax entity. Next, guys, is an HUF. I'll just put it down here as only. Next, guys, after individual is an HUF. Hindu Undivided Family, as you know, is a creation of India only. There is a Karta who's generally the senior most member. There are co-partners, and guys, even female members have equal share in the HUF. Guys, HUF has a separate tax entity. That means it pays its own taxes, but does not have a separate legal entity. Legally, it's the same as the members, but guys, for the tax purposes, it has its own PAN number and pays its own taxes. Next, guys, is a partnership firm. I'll call it partnership firm, assessed as such, assessed as a partnership firm. So just PFAS is a short form for partnership firm. You make a partnership deed and two or more people come together and form a partnership firm, guys. Most common CA firms are most partnership firms. In that case, you have a partnership deed. The partnership deed tells you how much the profit sharing ratio, etc. will be. And again, guys, partnership firm is a separate tax entity. That means they pay their own taxes, but they're not a separate legal entity. Nextly, guys, LLP. From the income tax perspective, guys, partnership firm and LLP are almost the same, except very few places where there is a difference in the taxability of the two. Otherwise, they are just the same. Next, guys, is a company. And as you've learned, guys, company is a separate tax entity and also a separate legal entity. You've learned this all through college. The company is a separate legal entity and also a separate tax entity. That's what I'm telling you right now. Guys, tax entity means it has its own PAN number, it pays its own taxes, and after paying its taxes, whatever is left can be given to the shareholders as dividend. Next, guys, AOP and BOI, I'm writing them together because they're discussed together, although they're slightly different. An association of person has only persons. That means it can be anyone. It could be one individual with one partnership firm or one company with one LLP coming together to do some business. That's an AOP. The difference is that AOP does not have a profit sharing ratio. Otherwise, it will become like a partnership firm. And a body of individual is again a couple of people coming together, but these are only individuals, no one else. So here 2-3 people come together and they come together because of something that has happened automatically, because of any provision in the law. Example, 3 neighbors get some property of the 4th neighbor in his will, so that 3 neighbors together will hold that property. That's a body of individual. Again, they're very close to partnership firm. The only thing is, why are they not partnership firm? Because there's no partnership deed which talks about a profit sharing ratio. And next, guys, is artificial jurisdictional persons. The Institute of Chartered Accountants of India, ICAI, you know, the Tirupati Trust, the Siddhivinayak Trust, all these trusts are artificial persons. Again, they also have their separate tax identity. Guys, all these persons which I've just listed down are in the definition of persons under the Income Tax Act, and each of them pays its own taxes on its own incomes. Guys, when they have to pay tax, all these people necessarily don't have to pay tax. You are today a student, you don't pay taxes, but when you become liable to pay tax, you are called an assessee. So the journey from a person to an assessee is this. And guys, once an assessee you've discussed, deemed assessee is someone who thinks he's not supposed to pay tax, but the government feels that he's supposed to pay tax. They're called deemed assessee or a representative assessee. Let's say there's a person who's abroad. So for him, there will be a person in India who will be targeted and termed as a representative assessee. Not really the most important. All these terms are very important from an exam perspective. Guys, again, this legal identity, whether an individual, HUF, partnership firm, LLP, company, matters because the tax rate matters. So in the exam, generally CA Inter focuses on individuals, HUFs and partnership firms. Companies, etc., are focused more at CA final level and not at CA Inter level. But you should know the concepts well. Also, guys, depending on which legal entity you are, your tax rates might differ. All right, moving ahead, guys. What's substantial interest? Substantial interest is something that is discussed in the first chapter. So if you hold 20% or more shares in a company, or if it's not a company, but if it's a partnership firm or it's any other entity and you hold 20% or more in the profit sharing ratio, then you are said that you are basically have substantial interest in that entity. All right, quickly discussing something that we use always, guys. What is the previous year? Previous year is the year where you make money, and then for whatever money you made in the previous year, all the formalities that you do, like return filing, paying your tax, etc., is something that you do in the assessment year. So these are both financial years. What I mean by financial years, they start on the 1st of April and end on the 31st of March. But guys, the difference is previous year is the year you make money, and assessment year is the year they assess you and you have to do all the formalities. I hope you understood that. Next, guys, in case you started a company in the previous year, let's say it's a new company started in the middle of the previous year, let's say on the 13th of February you started the company, then what is your previous year? Your previous year is from 13th of Feb till the 31st of March. So that means you'll have a shorter previous year. Yes, you have a very short previous year, but the next entire year is your assessment year. So assessment year does not change. Previous year changes in case you're a new entity or something that you started off in this year itself. All right, guys, let's talk a little about what is income, because guys, we're talking about the Income Tax Act and taxation happens only on the income. Let's talk a little about income. Guys, whether it's regular income or whether it's casual income. Regular basically means you're earning it every day, or casual, that means you're earning one on or one off. Whether it's a regular business or irregular business, when you're whether you're like Akshay Kumar making 10 movies in a year, or whether you're Amir Khan making one movie in 4 years, both of those are taxable under Income Tax Act. Even illegal income, guys, even illegal income, if it is noticed by the income tax officers, it is taxable if it is discovered. Guys, there is something called diversion of income. Diversion of income is basically before it even reaches you, you divert it. So in that case, there is no tax because you didn't receive it. Before you're receiving it, you divert it. That's called diversion of income, which is not taxable. But application of income basically means that you've earned some income and now you want to give it to someone, or let's say you want to donate it, etc. That is application of income. So it's reached your hands and hence it will be taxable. All right, guys, pin money. There's a concept called pin money. Pin money is when whoever runs the house, let's say at your home, your mom runs the house. I'm not making a sexist remark here. Just by the way, if your mom runs the house and your father makes the money and he gives money to the mother for expenditure, that money is called pin money. Guys, no income can be taxed twice. Double taxation is a sin. People don't want to pay tax even once. Why would you want to double tax it? So double taxation is something that is not supposed to be encouraged. And in case of reorganization of business, what is reorganization of business? Let's say I'm converting a proprietorship firm into a partnership firm, or let's say I'm doing a converting a partnership firm into a company. I'm ideally not changing anything except the structure. So in that case, any income, that income is not supposed to be taxed. Next, guys, let's move on to one of the last few items, but very important item. Guys, what are the steps that are required to determine the tax? What are the steps that are required? The first step that is required is you determine the legal identity of the person. Whether the person is an individual, partnership firm, LLP, company, etc., matters because the tax rate and the provisions are different for these different legal entities. Second, once you know the legal entity, find out the residential status, which is also a chapter that you've already done. Guys, residential status basically means whether you're a resident or whether you're a non-resident, because as you know, guys, residents, unlucky, they have to be taxed on their entire global income, and non-residents can be taxed only on their DIR income. You know what DIR is? We'll come to that in just some time. Next, once you discover the residential status, then you'll determine the scope of income. Scope of income is what all incomes are within the scope of the Income Tax Act. That means throw that fishing net, what all fish come into that net is the scope of income. Then next, guys, in the fourth stage, you determine the five heads. So you have five heads of income, starting with income from salaries. You know, the surgeon was a very hardworking guy. He got his first job at the age of 15. plus income from house property. He got his first house at the age of 22, plus income from profits and gains from business and profession, which he started his business at the age of 28. Then capital gains, where you start buying and selling shares, buying and selling gold, etc., which he started doing at the age of 45. And income from other sources, that is IFOS, another head that you've already done, which is under section 56. So you add up all the incomes from these heads, but guys, the intention of the Income Tax Act is not to tax your income, it is to tax your profit. So in each case, there will be incomes which will be added. You will minus the expenses, and ultimately you will get profit under each head, and you'll add all of them and you'll total. That is for you, that is your total income. Now, to that, guys, there is something called clubbing of income, which we will see in this session, in this leg of lectures. Guys, clubbing of income basically means you've transferred your income very smartly to someone else. Why? Because you don't want to pay tax at a higher rate, but that income comes back to you. It's a boomerang which comes back to you, and that is called clubbing of income. So you will add clubbing of income as well. Next stage, guys, is set off of losses. Now, what is set off? It's a very good thing. Just like the Income Tax Act wants to tax your income, they also want to allow you a loss deduction. So if you made any loss in the previous years and it's carried forward this year, or if you made any loss in this year, let's say I have two businesses, one is profit making, one is loss making, then that loss of one can be set off against the profit of the other. And that we will see in a chapter called set off. Very, very easy and nice chapter, which is a sixth step. As once you figure that, of course, set off will be minus. And once you figured that, the next step is called the gross total income. Gross total income is basically, out of all the steps, what is the resultant amount is a gross total income. From the gross total income, the government says that you should make some investments which we tell you to do, like provident fund, like take a house loan, like invest in Sukanya Samriddhi, invest in life insurance, buy health insurance, etc. And if you do, we will give you deduction, and they are called deduction under chapter 6A. And after minusing those deductions, whatever you remains is called the total income. And guys, from the taxability perspective, your entire focus should be on this total income. We're very close to ending the first chapter, guys. That is the introduction to introduction to DT, and this was the first chapter. While we did the first chapter, we also did rates of tax. So let's quickly also parallelly look at the chapter called rates of tax. Rates of tax, we do it in parts so that we are never confused. Let's quickly revise rates of tax. For individuals, guys, what is the rates of tax for individuals? In case you're a normal person basically means that you are not a senior citizen, or if you're a senior citizen, or if you're a super senior citizen, then what happens? Guys, we have slab rates. Up to 2.5 lakh rupees in case of normal people, there is no tax. From 2.5 lakh to 5 lakh, this bracket, you will pay tax at the rate of 5%. From 5 lakh to 10 lakh, this bracket, you pay tax at the rate of 20% progressive tax, guys. Higher you earn, higher you pay tax. And 10 lakhs plus you pay tax at the rate of 30%. What about senior citizen? Everything remains the same. Only thing is the basic exemption limit is 3 lakhs. So everything starts with 3 lakh. And for super senior citizens who've turned 80 or more in this year, guys, here this is 60 plus 60 or more, and here it is 80 or more. In this case, the basic exemption limit is 5 lakh. Everything else remains the same. Guys, in case you're a non-resident, then you don't get the higher basic exemption limit. Non-resident individuals also, the moment you're an individual, you get a basic exemption limit, but their basic exemption limit is only till 2,50,000. We'll look at more things like rebate, surcharge, etc. in some time, but that's the first session. I hope this revision was really, really nice. You can look at your book now, revise quickly, and be ready for the next revision. Thank you.